Good afternoon, everyone, and thank you for tuning in today to our webinar titled Impact Investments in Private Markets. Quick item to note before we start, you'll be muted throughout the entirety of the event, so we encourage you to enter any questions you may have into the question and answers box below. We will monitor the questions closely throughout the webinar and endeavor to have as many answered as possible. Also, this event will be recorded, for which we'll be sharing the replay afterwards. Before we dive in, I'd like to quickly just introduce myself. My name is William Reynolds, and I'm an investment associate at Fire Capital Management, as well as a member of the CFA Society San Francisco and volunteer member of our Young Leaders Council. In my role with Fire Capital, I assist in managing client portfolios and supporting the investment team in making informed decisions by evaluating and presenting updates on investments, market trends, and industries. I also play a key role in maintaining client relationships and developing investment strategies that align with clients' financial and impact-related goals. Now, I'd like to introduce our esteemed speaker today, Josh Hile. Josh Hile is the CEO, CIO, and co-founder of the private market investment platform, Citizen Mint. Josh has spent the last 10 years managing and consulting ultra-high net worth individuals, as well as pensions and 401k plans of Fortune 100 companies. Prior to co-founding Citizen Mint, Josh was the director of investment strategy and research at Laird Norton Weatherby, a $16 billion RIA, where he was instrumental in developing and maintaining and improving impact and sustainable investing capabilities for both public and private markets. He was further responsible for worldwide sourcing, ongoing due diligence, and monitoring of all equity asset managers, as well as real estate, private equity, private debt, and venture capital opportunities. And prior to this, Josh worked at Russell Investments performing due diligence on fund managers for Russell's mutual fund and consulting divisions. Mr. Hile has a BA in Business Administration and an MBA from the University of Washington's Foster School of Business. And in addition to that, Josh is both a CFA charter holder and certified public accountant. Josh, thank you so much for joining us today, and I'm personally thrilled to discuss today's topic of impact investments in private markets.
Thank you so much. So excited to be here.
Awesome. Well, before we dive into the particulars of today's subject, I think it'd be helpful if we set the stage for the audience. And by that, I think it'd be helpful if we differentiated to what the differences are between traditional, sustainable, and impact-related investments from a high level.
Yeah, definitely. So in like traditional investments, you're going to focus on maximizing financial returns on investments with little concern of kind of the negative externalities of those investments. So that's kind of the number one, you're just trying to get as high of returns as possible. It doesn't matter what you're doing and you just don't care. In the second, which would be like sustainable bucket, you're investing in companies that reduce risk and increase value through thoughtful consideration of all stakeholders. So you're incorporating employees, you're incorporating customers, local communities, shareholders, while limiting the negative externalities on society and the environment. And you can think of this in like even like you're treating your employees well, you're doing well within your communities, which helps your brand image, which is something that's not necessarily measured on the balance sheet, but it is something incredibly important to a business over time. And then the third category or bucket is impact investing. And these are investment opportunities, which are often in the private markets that seek to solve an environmental or social challenge while also trying to maximize financial returns. And some people might think of impact investing as philanthropy. It doesn't need to be, and it's supposed to be totally separate because you're really still trying to maximize those financial returns within that marketplace.
Yeah, and I think that's a great overview. And I guess let's dive a little deeper into this. So particularly as it relates to impact investing, where you said there doesn't necessarily need to be the philanthropic arm to it. There's also you could say, market return rate sort of investments. What would the differences in philosophies and objectives be for these different types of investments as it relates to that?
Yeah, and I think with the objectives on impact investing, and I'll make sure I'm actually going to share my screen just to show you a little bit of what this can look like. So, oops, 1 second. There we go. So you can kind of see the broad-based and like sustainable investing can kind of be encompassed in that SRI, ESG-based thematics, ESG. that can kind of go across that sustainable investing universe. But the different philosophies and processes, really on the impact investing side, you're really mostly going to look at that in private markets. Traditional investing can be in equities, bonds, but also private markets within that. But taking a broad-based approach of like, hey, we can go invest in something that might be detrimental to the environment, might be detrimental to society, but we are just trying to get the highest returns for our potential investors. So I think that's one of the differences in like the philosophy base, whereas like impact investing comes from it of like, well, first of all, it has to be a great return investment for us to get involved. So you start kind of at the same place where in traditional investing, in sustainable normal investing and impact investing, you're like, we still want to maximize returns. But then you kind of dive deeper into like, for impact investing, is this actually having a positive impact on society after you have that first level of diligence on like, is this also just a good investment to get into?
Perfect. And how would you say that the demand for these forms of investments have grown over the past 2 decades?
It's been rather significant in the demand side of things as people have thought about or even understood what their underlying investments are actually doing. And so, you know, we like, I'll show you kind of a demand chart, but it's actually one of the fastest growing segments in financial markets. If you just think about how much money is going into this, a lot of this does have to do with kind of this transition of energy and because there is so much money moving into the infrastructure market where we need to find replacements for energy or other parts of infrastructure. But also it's also related to just like the biggest issues we're facing out there need a lot of capital, whether it's in climate change, specifically energy, whether it's in education, healthcare, affordable housing. So it has been a place where people have been looking to put more capital because the opportunity set is so massive. And whenever there's a massive opportunity set, all investors start paying attention to that.
And before we dive into a little bit more about the asset classes, which you've already kind of alluded to there, but in terms of generationally, in the I would say that the problems that were faced by the older generations may not be the same problems that the younger generations may be more so valuing and or focusing on at the moment. How have you seen clients and financial advisors representing their clients approach you and Citizen Mint as it relates to value alignment with their investments?
Yeah, I think one of the big things is younger generations are much more attuned to essentially thinking about how their investments are going to impact society. From a taking a step back, so I was at a large wealth manager. Most baby boomer clients think of their money in two buckets. They think of their profit generation, and then they have their other side, which is their philanthropy. They don't like to intermix those, and they don't care if they're against each other. So you could be like, hey, I really care about this issue. And even if that issue is in their is something they're essentially creating negative externalities for in their profit making center, it's like, well, I'll just put money into my philanthropy center to offset that. Whereas future generations, or essentially millennials, are essentially saying, well, actually, I want those two to interconnect and I want to do good at the same time as my investments are doing good and not have these negative externalities and have to put more money into philanthropy to offset my negative externalities. So it's just a big mindset shift. And I think I'll pull up, kind of a couple things here just because I think they're important. This younger demographic are really looking at their investments and saying, okay, well, I want more alternatives in my portfolio. I want more sustainable things in my portfolio. So like, that's what I want to have. Also, what we've seen is the wealthier the person is at wealth management firms, in a lot of cases, some of the biggest or largest clients at certain wealth management firms are actually some of the most impact oriented. And so we've seen wealth managers either lose clients because they don't have enough impact or capabilities within that marketplace, or in the case of other wealth managers, have really built their business on the back of having this capability, whether it's Laird Norton Weatherby, whether it's Alti Tiedemann, whether it's Jordan Park, some of these big wealth managers within the space that are highly well respected, that have these big impact sustainability capabilities, and they've been able to grow their business quite significantly because of those capabilities internally.
Yeah, and I could personally say that at Fire Capital Management, we also adopt a similar philosophy, and we hear it as well from a lot of our younger clients, particularly. And yeah, they just like to see additional value be made from their returns. So that's really helpful. Thank you. Um, I guess let's go back a little bit. So you already alluded to some of the particular asset classes that you see where there's a lot of opportunity within impact investing, particularly as it relates to private markets. But can you, dive a little further or opine as to what you predominantly see in terms of underwriting and ongoing pipeline investment opportunities with Citizen Mint and in your past, and how
Yeah.
that's evolved over time?
Yeah, definitely. I mean, in the past, it was, or what it seemed like is it was mostly focused on maybe the VC universe. There was a lot of different opportunities within education or healthcare or other places where it's like, oh, this new technology is going to transform this specific part of the marketplace. And that's still the case. I mean, there's a ton of VC firms that are impact oriented, and are looking at those specific big opportunity sets and saying, okay, we can have a big impact here through technology. That said, there's other parts of the marketplace, which is where we really focus, like where our focus hasn't been on the VC universe. Our focus has more been on more even real assets, a lot of real estate, infrastructure, private debt backed by real assets. But we see those things as just massive opportunity sets. And we're not the only ones. I mean, Blackstone, KKR, Carlyle, Apollo, every one of them is jumping into similar spaces where they're saying, okay, well, we should be looking at energy from a renewable infrastructure standpoint, and we should be putting capital to work. Blackstone's likely going to be the biggest provider of affordable housing in the US just because it's such a massive issue. It's a bipartisan issue where it's like we all know that we need more affordable housing, whether you're on the East Coast, West Coast, or in between. And so this is going to be a place that is going to be investable. And you look back on it, also, the returns have been very strong within that area of the marketplace. And people just haven't really spent a lot of time looking at it. But Blackstone obviously has. And when you're hitting like 15% IRRs for these like affordable housing projects that have almost no downside, um, that's a pretty good place, like where I want to be playing too. So
Mhm.
from a perspective of us, we have really spent a lot of our time in infrastructure, in renewable infrastructure, affordable housing, and then private debt backed by some kind of real asset.
Yeah, and I think going back to your note earlier about, philanthropic versus market rate impact related returns, one particular investment that we've helped with clients is essentially below market rate loans provided to organizations that align with client values. So I think to your point about just the availability of opportunities has grown, and more opportunities for value alignment within a client portfolio, which is
Mhm.
helpful for wealth managers looking to grow out that sleeve of their
Exactly.
funds.
Yeah, exactly.
Yeah, no, that's great. And then I guess let's dive a little deeper into the actual due diligence process. So you have a great wealth of experience in due diligencing various assets, asset classes, impact, traditional, and sustainable. Um, how would you say that the due diligence process for an impact related investment, where there is a clear societal or environmental goal to be achieved outside of financial return, differs from that of a traditional investment?
Yeah, and I mean, I think it really starts roughly at the same place. You have a thesis for the marketplace where you're saying, okay, what looks like it's going to be an interesting opportunity based on the data set I have in front of me and what is out in the world. And you're saying, okay, there's like essentially five or six investable asset classes, and which ones look to be the most prominently placed to have a big impact or have a big compelling financial return. And then from there, reviewing what the actual like part of the marketplace that's investable, and then is that a compelling risk reward opportunity? So that even takes away like the impact side of it, where
Mhm.
we are going down the same place of, can we maximize financial returns here for unit of risk? And when we say yes, then we go to, is this having a positive impact on the world? And then from there, it's like, what are the actual investable opportunities beyond that? And are these opportunities actually impactful, or are they, greenwashing, where it's not actually having the impact you would expect it to have, or it's actually having a lot of negative externalities? Even it might have one positive impact, but it has tons of negative externalities surrounded about it. But there is that kind of like, beyond that, from just separating traditional and impact, is like making sure that those things that they say they're doing. So just to give you an example, in the case of affordable housing, is this actually having an impact on like new units built? Are these actual people who are living there being impacted positively from where they were previously? So you can
Mhm.
review that through, like, we actually, one of our managers does tenant surveys, because we build new affordable housing that's focused on 50 to 80% of AMI. And then after the fact, you can do tenant surveys to say, okay, how far did you drive before? How far do you drive now to your workplace? How has this impacted your happiness? How much more discretionary income do you have because this is like closer to your work, so you don't have to spend as much on transportation, or it's cheaper than the previous place you were living at? Like those kind of, all those things like that will factor into that tenant's happiness and like the impact you're having with that actual investment.
I think that's a great dovetail into reporting requirements, which is probably a question for many of the audience on the on the call, um, particularly as it relates to private markets, because being the nature that it is, it's a little bit more opaque and it's not as transparent as the public markets or companies. So you already alluded to surveying, but what would be other processes, or what are the current reporting requirements within private markets, if there are any?
Yeah, I mean, there's no required reporting requirements. There's some big systems out there that larger foundational investors have required when they're doing more institutional investments, like Impact Management Project or IMP, as well as IRIS or GERS or SASB. But most of them have some relation to three key elements. So um, materiality. So does the investment create material change and positive change? Measurability, can the impact actually be measured? And then intentionality. So is the investment intentionally made to create positive or social environmental impact? Because there's a lot of VC investors out there, and I'm sure San Francisco, love you, if there's any VCs on the call, but they'll be like, well, VC is the most impactful part of the marketplace because we create so many positive jobs that are high paying jobs. And it's like, well, is that actually intentional in the process to create positive impact? Is this actually bringing people out of poverty, or is this actually, a tech worker moving from Amazon to this other job? And does that actually create like meaningful, like upward like impact?
Mhm.
But so there's a lot of different systems. That said, there's a lot of ways to measure it, and people can measure it in however they want. But that is not too dissimilar from what you can do in public markets, in the way you can, increase your ratings from a sustainability perspective by changing the way or your methodology for creating it, as long as you have somebody sign off on that, which most people will. That's why Exxon is rated one of the highest like sustainability companies. Um, Even though it's like, well, are they just hiring more people and having more consultants say that they're so sustainable? Or are they being positive for the world or not?
Mhm.
So again, upfront though, what we try to do on our side of things is work with the manager to say, here are the things we would like to report on. Here are the things we require of you to report on a quarterly basis. And here's like kind of like the discussion on methodology of how we would like you to measure that. And then we work from there of like reporting that back to our individual investors, knowing that, nothing's going to be perfect. And There's errors in estimates, but we're trying to do the best we can. And as long as it's directionally correct, we feel that we can feel good about the impact of that specific opportunity.
I think that also dovetails nicely into a follow-up question on ongoing monitoring as it relates to private investments. So I guess for the audience, particularly within private markets, a lot of these investments are illiquid in nature. So being able to exit a position if something were to change, such as style drift or what have you, then it's not as easily said or it's not as easy as said and done. And so I guess in that regard, particularly with impact related goals, how does the ongoing monitor process look like from your perspective when you're reporting on these impact related objectives?
It just depends. And I'll probably say that 100 more times because it's so different based on the investment. In some cases, it's relatively easy. When you're essentially creating energy from like solar or wind, it's tons of carbon abated. It's a pretty normal metric within the industry. But then we put it into things that people can actually understand because nobody knows what 1 ton of carbon abated actually means. But when you say you took 100 cars off the freeway for a year, by 1 ton, being taken out, or you took like 50 trips from London to LA out of the network by like similar carbon metrics. But those are pretty easy to understand, and they're also easier to measure compared to like maybe affordable housing or a healthcare or an education investment, where you might have to do some more metrics around like who you're actually serving. Because in affordable housing case, it depends on the level of affordable housing because you could be doing like actual low income housing, or you could be doing some level between, which would be like between 50 to 100% of AMI. And AMIs can range dramatically by the region you live in. In the Seattle
Mhm.
region where I'm based, AMI is 120,000. And so you might be like, even though you're focusing on retail workers, teachers, nurses, others who can't usually live near their workplace because it's so expensive, those people are still not making what you'd consider as like low salaries when you're making 70 to $80,000 a year. But it's like within that environment, it's still hard to live on some of those salaries. So we try to measure it in different ways. I think from you usually don't have, because we're not investing in companies or businesses, you don't have the same style drift that you might have with an individual company where they're changing their whole focus or they're pivoting, or they might like get rid of their sustainability programs at any one point in time. That just doesn't really happen with like affordable housing or a solar project or even a battery project or whatever it might be within that infrastructure space. So we just don't see it as often, um, unless you're
Okay.
doing individual companies.
No, and that makes sense too from that perspective. I guess looking forward, so AI has been the craze of the news, the markets over the past 5 to 10 years, really, and its evolution even more recently than that has been on a J curve. Um, with AI, there is a energy consumption requirement through data centers, and I imagine in terms of asset allocation for the investment opportunities going forward, infrastructure around that is going to be huge. I guess, can you speak more about that and from what you're hearing on your clients and financial advisors as to how they want to allocate towards that, future world that we're heading towards?
Yeah, definitely. And I'm gonna bring up my um, presentation again to show you a little stats around that because I think it's such an interesting topic. Um, so AI is going to be revolutionary. I mean, obviously, it's already starting to like roll into many of the things like we do on a daily basis. But like it's going to impact the energy landscape massively. It's also going to impact the renewable infrastructure landscape massively. Like it's actually renewable infrastructure is going to be huge, and renewable infrastructure investments are going to be a huge beneficiary actually of AI, because you have all these big tech companies looking to have some level of sustainability within. I mean, they've all essentially said 2030 carbon neutral around that time period. And they're moving as fast as they can towards that, and they're putting a lot of dollars behind it. So all of them have these 50 to 100% energy teams that are constantly trying to figure out how to just get new energy, and they're trying to get it from renewable sources in most cases, because that's where most of the new energy is coming from. So they're putting a lot of capital behind it, but like AI is a whole nother level step above that of how much energy you need. So you need 4 times the amount of energy to power a normal data center. And Mark Zuckerberg came out and just said energy, not compute, will be the number one bottleneck for AI. And you already see this. I mean, data centers are essentially trying to upgrade to NVIDIA chips, and the utilities are essentially saying, no, you can't. So that is the number one investable part of like investing in a data center is, can it actually upgrade, or can it, when you build that data center, will it have enough power so that it's attractive to a corporate purchaser to be able to like be willing to put the chips there. And so it's a massive problem that we're dealing with right now. You saw Microsoft turn on an old nuclear plant. You see Amazon signing nuclear deals as well. I mean, Amazon's deal with X Energy essentially is like 10 years out, so it doesn't even have any impact on the current necessity or needs of that company. But you even see like in 2030, just alone, US data centers will be the sixth largest user of energy in the world. So I mean, you're in front of South Korea, Brazil, Canada, Germany, France, just by our US data centers and how much energy we're going to need. That's crazy. And on top of that, like you even see like just how fast the power demands are increasing. And this goes like our power demands were pretty set for a long period of time. And then you had EV come on, you have onshoring and manufacturing, which is only likely to increase under the Trump administration and the tariff. That's likely to go into place, and so you're going to see more and more businesses try to produce domestically. I mean, it's been a big shift over the last 5 years already, like because we knew we needed to do that, but it's going to go up even further, and people don't realize how much energy manufacturing takes. But on top of that, you have AI. So these are just the power demand forecasts on this top chart that show how much it needs to increase, or how much it's increased that estimate from 2021 to 2024. It's been significant. So all that said is you need new energy. You want it from a sustainable source, and these companies are demanding it from a sustainable source. So this is going to be a huge opportunity to renewable infrastructure developers and the investors that we invest with.
Yeah, and I think that's all you highlighted it all very well. Clearly, there's a lot of secular tailwinds ahead for impact-related investments, where investors are able to achieve more with their financial resources than just returns, as there's just a clear need on the demand side from an energy perspective.
Yeah.
In terms of additional high level, positives that impact investing can bring to a portfolio, can you just opine to some of that as well?
Yeah, and uh, I think one of the biggest and is most investors, I think, need to understand like there is a lot of diversification benefits for this overall asset class. I mean, like, I guess asset sector, not asset class. But you these investments, say let's call it infrastructure for one thing. So renewable infrastructure, it has half the volatility of the U.S. stock market. It has less than half the volatility of private equity, while producing, roughly around 12 to 14% type of returns, net returns to investors, based on current Inflation Reduction Act, like tax incentives, as well as just the demand for the underlying opportunities. On top of that, it can be tax advantaged. If you look at affordable housing, similar case where it's like super low risk, especially in the lower income housing areas. It's like those tenants usually stay there for 10 years at a time compared to 18 months for a normal market rate tenant. They uh, they can increase rents even during recessionary periods based on subsidies provided by the government and other places. They're hitting like roughly like 15% net IRRs to investors. And they have incredibly low risk compared to like a market rate apartment. So I think there's a lot diversification you can get within these specific asset classes. Even, one of the opportunities that we saw was in private equity. You can do an ESOP private equity fund, and you are using small business administration loans at much lower rates than the private direct lenders are providing to, say, the big private equity companies like Bistria and like Blackstone. So you're getting like 6% debt rates, and you're buying these companies at 7 times EBITDA compared to 9 to 10 that private equity is usually buying at, because the founder or the seller actually gets significant tax benefits by selling their business into an ESOP. So lower purchase price on acquisition, you get lower interest rates on your debt, which creates a better return outcome ultimately for investors. So and lower risk actually, because when you're buying into an ESOP, there's warrants attached to it as well as debt. So you're kind of in this in between risk position between mezzanine debt opportunity and a private equity opportunity. So you usually have lower risk than a normal private equity opportunity. So I think suffice to say, there's a lot of opportunities where you can reduce your risk, diversify portfolio. But most investors have not been able to like see that through kind of the noise of what's been going out there politically.
And I think, as it relates to portfolio composition, corporations, endowments, sovereign wealth funds, they're typically first movers, especially in the private space, on some of these more sustainable strategies. As it relates to the allocation of your investors that you particularly manage and see within private markets impact investments, would you say it's predominantly corporations, or are you starting to see the ultra high net worth come into the fold more so?
Yeah. I think it's mostly, I mean, for us, we do work with some foundations who have been trying to increase their allocations to this to align with their missions of the foundation, where it's like, well, hey, if we can get investments that are similar rate returns to what we need to maintain like our foundation indefinitely, and it more aligns with our mission of our foundation, then we should be doing that. And I think there's more and more foundations that are looking to do that within their portfolios. From a corporation perspective, it goes the same way. But that said, we're mostly dealing with ultra high net worth individuals on our platform, and wealth managers and their clients who want to align their values. In a lot of cases, though, I mean, we work with a lot of wealth management firms who are just excited about the returns. And, probably about 70% of the wealth managers we work with, um, a lot of them don't care about impact or their clients, but the returns are so compelling and the risk is much lower than in other places in the market, to diversify client portfolios here, that it just makes a lot of sense for them. And so that's, I think, where we can, still have a positive impact on our end, but then they're getting diversification and hitting their clients' financial goals, which is a win-win for everybody.
Oh, that's really interesting. We got a question in from the audience here. So, Josh, I'm curious if maybe you have an outlook on this, but given federal policy, particularly going forward, how much do you think that will impact energy generation in the US and its mix between renewable, traditional, or nuclear? And or do you see this being more of an economic decision?
Yeah. I so this is that's a softball to what you really want to ask, which is Trump going to take out the Inflation Reduction Act, which should be the real question. And so what I think, I mean, like, and we've opined on this with a lot of experts within the field, and it's likely going to be more a scalpel approach, or a rebranding approach compared to an actual like full repeal. First of all, it's really hard to repeal that big of an act. Secondly, and I don't have the chart like in front of me, but I'll probably follow up on it. But it's essentially benefited mostly red states. I mean, the Inflation Reduction Act has been the biggest boon for red states and oil companies because they're actually huge renewable energy providers as well. So of the 200, and I have this chart, but of the 225 billion spent, and this was several months ago, 190 billion had gone to red states. So Texas is the biggest renewable energy provider in the US by far, way bigger than California, and the future projects are way bigger than California. Texas relies 35 to 45% of its grid on solar wind energy. You can look it up on ERCOT, which is and see their daily mix. And most of the production of new jobs, so for solar, for EV manufacturing, for onshoring of like actually the solar arrays is going on in Ohio, North Carolina, and batteries, North Carolina, Alabama, Louisiana, and Texas. So those are all red states based on the most recent data. So is Trump going to destroy jobs? Probably not. He's probably not going to try to destroy jobs, especially in Texas. Doesn't really want to mess with Texas. On top of that, Elon being part of the new administration in not a formal role, but we know he's there. So it's likely that he wants those things to stay in place because they're hugely beneficiary to the profitability of Texas. I mean, people forget that Tesla is one of the biggest battery producers in the world. And so on top of that, they have a residential solar. And on top of that, they get massive tax credits through selling EVs, cars. So you would really like if they took out a lot of those incentives, Tesla's probably down 30%, maybe 40%. So I just don't see it happening. And most even like Republicans don't like who are experts on this topic don't see it happening. I think it's also going to be an economic decision to your point. Because essentially you already have oil at $70 a barrel. Natural gas is super cheap. It's unprofitable to drill for new natural gas because people will be like, natural gas isn't, we should just drill more. And it's like, well, it's unprofitable. So why would you drill more? And it's like, if you drill a ton more oil and you're going to drop it to 50, then it becomes unprofitable for oil companies. So it's like, we're not going to do that. So it is an economic decision at the end of the day. Now, nuclear is still 10 years out at the very earliest. It is going to be part of the solution and they're going to work to add it in, but it takes a long time to put nuclear in place, even like small modular, because people don't want nuclear near their homes, even though it's mostly safe. They just don't want it near their homes.
Yeah, no, and I think that was a great just overview on the overall broader implications of what federal policy has to take into account as it
Yeah.
relates to future energy generation.
Yeah.
So, yeah, great points. Well, I do believe that answers all of our questions that we have for the call, and we're nearing the end here. But Josh, if there's anything else you just may want to add prior to, logging off here, I'll leave the floor to you right now.
No, I think we'll follow up with some resources that you can look at. You can look at citizenman.com, where we have a ton of white papers on different parts of the marketplace, and try to dive deep into each one of those. We also put up a lot of blogs around like things like new administrations coming in, where we try to provide expert opinions on what individuals are saying about it and what part of the markets are investable, what parts aren't. But if you have any questions, you can reach out to me directly at josh@citizenman.com, and happy to answer any additional questions.
Awesome. Well, thank you so much, Josh, for your time today. And thank you everyone that's listening in. And I'd like to, wish you all a great rest of your day. And thank you.
All right, thanks, William.